Good day, fellow investors. Today we're going to talk about strategy, index funds versus stock picking, because string theory down below asked, okay Sven, you talk a lot, risks, reward, crashes, investing long term. What's the difference between index funds and stock picking? Because Harry said that blah blah blah, yes, the Dow will be at 50,000 points in 2025. And I answered, possible also 60,000 points. So I really believe that the S&P 500 can double by 2030, so 8,000 points. Which means both strategies are good. Index funds, good, and stock picking, good, because both strategies are positive sum long-term investing strategies, which is key when it comes to building wealth over the long term. And what I'm going to explain in this video are the key drivers for investing returns, what's the difference between index funds and stock picking, so that you can pick what is best for you. You know yourself, you need to have the data, which we'll go through, and then you can make the right decision. What's best for me? The key when it comes to investing in life is finding your investment vehicle. There are plenty of good investment vehicles, and if you pick among those, you'll do well in life. That's the key. If this video gives you an answer and value, please click that like button because it helps with the YouTube algorithm. And if you want to learn more about the investment mindset on this channel, please consider subscribing. Let's start with just a notion of putting things in perspective 2021. We have a bad economy and plenty of money. Just a quick recent news, the Dutch National Bank said how Dutch people added 487 billion euros to their saving accounts, just sitting there on the saving account. Which means that if I divide by 17.2 million people, on average, every Dutch person has 28,000 sitting on his bank account doing nothing. So that's the average over the whole country, and getting zero, which means people are looking for things to do with that money. And the consequence is pretty simple. We have had zero interest rates for longer, and the S&P 500 over the last 11 years is up 440% from 600 something points to the current 3,714 points. If we look at the German index, also significantly up, what is this, 3 times since the financial crisis. More money, low interest rates, and stocks go higher, higher, and higher. And also the dividend yield for the S&P 500 is just 1.55%, and for the DAX index is 2.22%. Interest rates are zero, or in some countries, depending on how much money you have, negative. So in this environment, is it still smart to invest in index funds? Okay, dividend yields of 2% are still better than zero in the bank, but also we know stocks are volatile and stocks go up and down, as we have seen in the chart. So we have to explain what are the drivers for index fund returns, and then for individual stock returns, and then again you'll see what's the best answer for you, and I'll also share my answer for me, what's the best for me. If we look at Morgan Stanley's projection for long-term investing returns, nominal investing returns over the next 10 years, we have the S&P 500 at 6.3 per year. We have European stocks at 9.3, which is significantly higher than the S&P 500. We have seen also the higher dividend in Germany respective to the S&P 500, Japan 7%, emerging markets 6%, bonds 1.4%, very, very bad, and also high yield, very risky junk bonds just 2.5%, which is much lower than the historical averages, except for stocks that are still there in line. We'll explain now what drives these returns. There are three components that drive investment returns. Is the price you pay versus what you get, so versus the earnings, the value that the business you own when you buy it delivers to you in that moment. Then you are buying a dynamic entity that grows hopefully in the future. Thus you have organic growth, and businesses, if they can increase prices, also protect you from inflation. So that is the trifecta of investing returns. If we take a look at S&P 500 earnings, these are the forecasted earnings for the next 12 months. And those earnings are always a little bit exuberant, and we have the S&P 500 earnings now forecasted to be next year 170 points. But forecasts are always a little bit too exuberant. Let's take reality. So here we have, this is from macro trends and S&P 500 earnings. If you want to find this chart, here we have the real earnings over time, the orange line. So earnings were around 90, then Trump lowered taxes, so earnings jumped significantly. And we are now, or we have been in 2019 at 140 points. Now we have a crisis, so earnings are lower, but as we recover from the crisis, earnings will likely be again around 140 points and then continue growing at the standard earnings growth rate. If I put this into a current earnings versus price perspective, S&P 500 3,714 points, earnings 140, price to earnings ratio dividing 3,700 with 140 is 26, and if I look at the earnings yield, 100 divided by 26, I get an earnings yield of 3.77%. That is the earnings that on average businesses from the S&P 500 deliver per year to the shareholder. Okay, that is much better than the 0 or the 0.5 or the 1% that you could get in a bank or bonds. So why are stocks giving a higher return? That's because, academically speaking, because of the risk premium. And recently the Modern, if there is one YouTube channel that I recommend subscribing for great learning purposes, educational purposes, that is Ashwat Damodaran from the New York Stern School of Business. So check out his channel too. And also he says that there is a risk premium because stocks are considered more risky than, let's say, a bond or a bank account. And the risk premium is the difference between a 5 or a 10-year bond and the earnings rate or the expected returns for the S&P 500. Now we are around 5% when we add growth inflation, but the earnings premium was close to 8% in the 2020 March lows when everybody was afraid about the COVID crisis. And historically, we are now at an even historical risk premium. So what is the added value from stocks? We are now at what, 5%, and historically it has been always around 4%. So stocks, because of their volatility, give, or people require a higher risk in comparison to where there is, let's say, no risk, like bonds or bank accounts. But there is one key difference in returns. If the returns on bonds are 0 or 1%, and then you add the risk premium, you still get to a long-term return of 5.65%, which is much lower than what was the long-term return and what people expect from stocks over time. Yes, over the last 60 years, it was 10%. Now we are at 6%. And this is something very, very important. The other two components of your investment returns are the growth of the earnings in the future and also inflation. If we again look at the earnings, those over time grow. And if we look at historical earnings over 30 years, the S&P 500 earnings went from 20 points 30 years ago to the current 140 points. If I divide 140 divided by 20, that's 7 times up. And then over 30 years, that's approximately 6% earnings growth over time. Historically, let's say that 1920s it was 1, we are now in 140, 140 divided by 1, of course it's 1. If we try to take it 100 years, what's the yearly return over 100 years? It's around 5%, and it's the average. Sometimes it's slower, sometimes it's faster. 5% earnings growth, 5% earnings growth over time adds to stock market investing returns. So if we add, let's say, organic growth 2%, inflation, average inflation long-term 3%, we get to a total S&P 500 return from current position of 8.77%. Of course, this depends on inflation, because if inflation is just 1%, not 3%, then the return is 6.77%. There are recessions, slower growth, etc., etc., but that is for another story then. Also, if you own the S&P 500, you own amazing companies: Apple, Microsoft, Amazon, Facebook, amazing Tesla, of course, Alphabet, Berkshire, J&J, so companies that will likely be around for the next 50 years, at least most of them. Grow their earnings and deliver what is the historical return for investing in stocks, which again, from the Damodaran or Shiller, 9%, 9.7%, depending on what's the time frame you look at, but stocks have delivered around 8 to 10% long-term nominal returns, which means that $1 in 1900 till now would be $58,000. However, keep in mind the difference in inflation, which is average 3% per year, $1 in real purchasing power, with bonds gives you nothing, $10, but still $2,000. This is 3% of nominal returns. The difference between this and this is inflation. If you own businesses, you are long-term, let's say, protected from inflation. So you might think, Sven, you're now saying that the S&P 500, even at these bubble times, will return 8% per year. 8% depending also on inflation. 6% is more likely. But still, these are historical averages depending on inflation, on the economy, on the growth rate, and let's compare now with stocks, but also we'll discuss later the risks of investing in index funds, what can go wrong and jeopardize your investment, let's say retirement plans, and let's talk also about stocks. Let me give you an example of what are stocks compared to index funds. So in a recent video I discussed grocery stocks. One of them is Kroger. When I discussed this, the price-earnings ratio was about 15, so that is already much better than the price earnings of the S&P 500. So stock, this is the return. If the growth, as it's a grocer, is just 1% and equal growth on inflation, with Kroger stocks I get to 10.5%, which is still higher than the S&P 500. Not much, but significant. And if you can get 20 stocks like this, then you have diversified your risk and you should have a long-term higher return than the S&P 500. That's my reasoning for investing in stocks. Of course, investing in stocks requires work because you have to analyze the companies, know what's going on, and you have to see whether investing in stocks is worth it or not for you. The differences are significant, but maybe you just focus on doing what you know how to do, your job, your business, and invest the money automatically in index funds. That's a big advantage of index funds. Let's check the difference. This is Investor Government Compound Interest Calculator. Let's start with 10,000 today. Let's say we add 1,000 to our investment per month. Let's say we invest for 20 years. Is interest rate, we said, let's say stocks 10% and interest variance rate, let's say S&P 500 8%. So I put 2 here. And now I calculate, and the results are that in 20 years with 10% and investing 1,000 per month, I'll have $754,000. Let's compare this with 2% less, which is the variance here below, and you can see that the difference is approximately $150,000. So $754,000 with 10%. If you get 12%, you are again higher. And I am targeting this difference, the variance above of 12% versus the variance below of what the index funds will likely get me. That's doubling my money over 20 years, over 40 years. So this is the reason why I invest in stocks. But keep in mind that the variance below the S&P 500 is still great, and especially for not thinking. As I said, it is a positive sum game. You just have to see what's best for you. And another thing that might put things into perspective a little bit, we discussed how the S&P 500 is in a bubble, stocks are in a bubble, especially tech stocks with no valuation, NEO for example, that I discussed in a video on Friday. But let's put things into perspective. The S&P 500 dividend is 1.5%, and it has been low for the last 2 decades. But in history, the S&P 500 dividend was on average 4%, with even spikes to 7-8%. This is really incredible compared to what we have now. So let's put things into a dividend perspective, because dividends is what you're going to eat 10-20 years down the road. Stocks will go up and down, but dividends is what will be the steady deliverance for your investment returns. And if we invest in the S&P 500, yes, dividends will be double in 10 years. So if you invest $1 million now, you will get dividends of 15,000 likely over a year. If those dividends grow, that will be 30,000 on the $1 million invested in 2030, 60,000 in 2040. And then you have to see, okay, if I put my money there, I get 60,000 per year likely in 2040, 30,000 in 2030. How does that fit my other options? If I put $1 million in a home rental with all the costs and everything, do I get more than 30,000 per year in 2030? So if we look at S&P 500 dividends over the last decade, the dividend was 25 points 10 years ago, and now we are at 57 points for the 1.5% yield. This is from S&P 500 Dow Jones Indices Dividend Points Index. But let's look a little bit at the risks. I have this intrinsic value template. You can download it directly in the link in the description below of this video. And I have put the dividend of the S&P 500, and I have put that it grows at 5% per year over the next 10 years. I have set a discount rate of 5%, and let's say that we need a 2% dividend yield. 100 divided by 2 is 50 terminal multiple in 2030, and the intrinsic value of the S&P 500 for a 5% discount rate is 3,284 points. If we stick to the 1.5% dividend yield, it's still a little bit undervalued. So long-term returns, you have the basis that's safe, it's the dividend, and I think it will double in 2030. But the question for your long-term returns, and the key thinking when it comes to index funds, are you basing your whole retirement strategies on the premise that stocks will go up? That's the key question to see whether you're okay with that or not. Because if the dividend changes, the required dividend changes, if we have higher interest rates than we have had the last 10 years, if the required dividend yield goes to 4% for the S&P 500, which has been the historical average, then things might also change from that stocks always go up perspective. Just let's put here a terminal multiple of 4% dividend yield. Then the S&P 500 in 2030 will be just 2,220 points, which means a decline of 33% for a current intrinsic value of 2,000 points, which shows that in this case indexes are in a bubble if we return to the historical averages for dividend yields and interest rates. Interest rates always go up and down, so mean reversion will happen at some point in time. And if that happens and hits the S&P 500, then a lot of those that think that stocks always go up might be very unpleasantly surprised from that stocks go up perspective. But from another perspective, you are now reinvesting at a 4% dividend yield, which will increase your long-term returns much better. If you're a long-term investor, 10, 20 years, you have to hope that your holdings go down 50, 60, 70% now, because by buying them at a lower price, you increase the long-term returns. So it is counterintuitive, but if stocks go lower, you should be happier, not the other way around, because if those go up, the reinvested dividend leads to lower returns. And if those required dividends changes, then this can happen. 25 years of zero returns, 9 years of zero returns, 12 years of zero returns if the expectations are not met, or if the dividend required yield changes, as it was the case in the 1970s. And this is inflation included. If we look at inflation-adjusted returns for the S&P 500 since the peak in 1968, it took, what is this, 25 years to get back to zero. And people think this was a tragedy, but actually for real investors this was a blessing, because those kept buying at these lows like Buffett and had amazing returns from here where nobody wanted to touch stocks to here when everybody was exuberant about stocks. We are now again in exuberant times, and as you can see, everybody is extremely bullish on US stocks now. That's the big weight. We'll be looking at Germany and emerging markets over the coming months. My intern will look at Germany, so you can expect more videos, and then you can compare, you can see what's better for you. Long-term risks. Of course, if we look at long-term investment returns over the last 120 years, we have US that did almost 10%, which is great. On average, the world 8%, Europe 7%, so business return 4%, inflation 3%, and you have these returns. Now, the expectations are that the S&P 500 will deliver from this point 6%, which is still good. But should now one invest in stocks or not? Well, that also depends on the kind of stocks you are investing in. If we look at Jim Cramer's 2000 stock picks, you see how all those did terribly, and it was better for the investor to invest in index funds, let's say, at that time. So it's also about picking the right stock. And if we look a little bit at examples, this is my valuation of NIO, and it's really exuberant things have to happen for a car company to pay dividends, grow 15% or more, and have a terminal multiple price-earnings ratio of 50. That's very exuberant. If things return to the normal in the car industry, NIO stock price will be much, much lower. Let's take a look at Kroger. We can expect a 7-8% return at the current stock price. I think it went higher since I made the analysis, but much more reasonable growth rates, terminal multiple of just 15 on the cash flow. Also, if you want to be a value investor, this is from my book, Modern Value Investing, and you see how, yes, sometimes growth outperforms value, but over the years, on average, 5% higher yearly returns from value investing than from what's called growth investing. Then we can debate a lot what's growth. I don't agree with this value investing definition. I think value investing is about the future, not about past metrics, but that's again questioning how deep do you want to go into investing. Also, some countries over 50 years delivered negative investment returns. It also depends on what's the starting point. Some countries did really, really good. And here is the key, I think, for everything. Whatever you decide, what will be your long-term investing strategy, there is always the key risk is you. What will you do when things don't go as planned? And when it comes to investing, that's why you have that risk premium. Things often don't go as planned. Benjamin Graham, the author of The Intelligent Investor, said that investor's chief problem and even his worst enemy is likely to be himself. And if we look at JP Morgan's 20-year returns, we have here the S&P 500 with 6% annualized returns, but the average investor brought home 2.5%. Perhaps they are betting too much on stocks, crazy stocks like NIO or things like that, and on the long term it delivers very bad returns. So it's up to you whether you want to accumulate wealth over time. When something goes down, you buy more, you're happy for that, and then you achieve 6.5% or even more. If you sell in fear when stocks are down, like many did in 2009, and buying greed at unprecedented stock market highs, because now stocks are the only option, so attractive. Here, nobody wanted to touch stocks. Nobody wanted to. When I started investing in 2002, everybody said, oh, you're crazy, stocks. Everybody lost a lot of money on stocks because of this, the dot-com bubble. Then in 2009, stocks, stay away from stocks, whoa, because of the financial crisis. Now everybody's into stocks because there is no other option. And that's again a risk about stocks. Everybody is buying today, and that tells you historically from a behavioral investing perspective that there is a high risk. And now you have to decide what's best for you. Index funds, 5%, 6%, 10%, depending on what happens in the market, inflation, the required dividend yield, and also the low dividend that is there now. That will be the determinants of index fund investing, but low cost, and you don't have to think about it. The key is also to compare the returns there to other options in your life. If you have a credit card interest rate of 13% or a student loan of 7%, then compare to the current 6%, 7% of index fund. With the volatility, you pay off the student loan. If you have a mortgage of 2% fixed for long term, and you have stocks that will lead 5% without thinking, then you also have your answer. When it comes to stocks, and this is my personal preference, because I decide what do I want to own. Of course, good companies, but Apple, we made a video, overvalued. Tesla, no comment. So I don't want to own Apple now. I don't want to own Tesla now. And that's what I don't like about index funds. Tesla just entered an index fund. And yes, it did good since it entered the index fund. But the index fund didn't buy here. It buys here when the stock is already up 10 times or even more from the IPO. If I wanted to own Tesla, I could have bought it here for myself and then accept the risk reward. Index fund have to include it because the market capitalization is huge, and the key driver of index fund investment is the market capitalization. That's something I don't like. I prefer to decide by myself what I want to own. Plus, I want to decide and look at the top 10 S&P 500 components for 2000. So General Electric, that wasn't something that ended well with a 500 billion market capitalization. ExxonMobil also did not end really well. Citigroup went bust. Cisco recovered a little bit. Walmart did well, but not spectacularly. AIG went bust. So you don't have a choice on what you want to own. It all depends on what the market thinks, on the market capitalization. And then, of course, the bubble bursts. So you don't have control over that. Personally, I have a passion for owning businesses. I have a passion for constantly comparing what are the real dividend earnings returns over time, no matter what the market expects. I want to get my dividends, I compare them to the S&P 500. If the S&P 500 would now be at 1,000 points, this channel would be called Index Fund Investing with Sven Karlin. All else equal. And I would make 5 videos a day screaming to people buy index funds at 1,000 points. It's 4,000 points, and I just simply like to use common sense, but it requires also effort. So I'm not saying nothing bad about index funds, I'm just saying it depends on you. As I said, possible down 50%, okay, the dividend yield will still be 3%, but let's say I own something that is okay, going down 50%, and then the dividend goes from the current 6 to 12%. This 6%, 10% yield compared to the 3% is what will make a huge difference long term. Because yes, stocks can go up for longer, but the higher those go, the lower is your long-term return. And I firmly believe that if you have an active, common sense investing mindset, then you are open to hitting the jackpot a few times in your life. If you just think, okay, automatic S&P 500 index fund and that's it, you don't even spend half an hour thinking of what you are buying and why, then you will miss on what Charlie Munger says, that you only need 3 great investments in your life. The key is that you have to recognize that in those investments. And perhaps the S&P 500 will do 8%, perhaps will do 8% over the next 10 years, and then in 2031, the S&P 500 will still do 8%, but by looking and everything, will recognize the great investment and do 100% in 1 year, because all the indications of value investing will be there, and that will make a whole difference because it will lead to double the investment returns over time. And that's why I put so much effort into investing education. It has worked enormously well for me. If I would have put only my money in index funds in 2002, I would have made 5 times my money. I have made 20 times. So that's the difference. Also, 2013, I was looking around. The houses in the Netherlands were cheap, and we did everything we could to buy. Index fund investing would be buy whenever, no matter what, and that's a huge difference that leads to okay in life, but I prefer always to strive for the 1% that do great in life. That's my opinion. I hope I have given you the risks and the rewards for everything, and you can make your own educated decision now. If you like this, click that like button. Looking forward to your comments, and I'll see you in the next video.